Welcome to This Explainer. Look, if you've ever wondered why building products in the financial sector feels, well, fundamentally different from traditional tech, or why your standard product playbooks suddenly catch fire the second real money is involved, you are exactly in the right place. Today, we're diving straight into the high-stakes crucible of fintech. And I want to kick things off with a jarring quote from our sources that perfectly sets the stakes here. Traditional tech PMs optimize for engagement. Fintech PMs optimize for survivability. Think about that for a second. In regular software, your biggest enemy is users just getting bored and churning. But in fintech, your biggest enemy is a systemic failure, a brutal regulatory audit, or a massive fine that literally shuts your doors. You aren't just shipping code, you are managing immense risk. So, to unpack this, we're going to navigate this intense battlefield, break down the two crucial roles you need, the product manager and the product owner, and then look at how they tackle massive hurdles like legacy mainframes and strict regulations to actually win. Let's jump right into that first piece, the crucible itself, because operating here demands a total mindset shift from day one. Just look at this contrast. In consumer apps, what are you obsessing over? Daily active users, session length, right? But as our sources from DataBrain point out, if you only optimize for app downloads in fintech, your business might literally fail an audit and collapse. Instead, you're looking at things like fraud rate. A 15 basis point fraud rate on $1 billion in volume, that is a massive direct loss. Or you're tracking anti-money laundering alert conversion rates. The whole definition of success is just completely inverted. Okay, so who navigates this mess? First up, the product manager, our strategist. The core thing to understand here is that a fintech PM isn't just dreaming up flashy new features. They own the what and the why. They have to figure out what the market actually needs and why it makes business sense. But unlike their peers in regular SaaS, their why has to be absolutely bulletproof against compliance checks. They are constantly balancing user value against severe regulatory exposure. To give you a sense of their day-to-day, consider this wild example from the sources. A PM at a fast-scaling neobank ships a slick one-click savings feature. Opt-ins shoot up by 37%. Sounds like a massive win, right? Well, it was forcibly rolled back 2 weeks later because internal audit flagged it as a potential UDAP violation, an unfair, deceptive, or abusive act or practice. So you see, a PM has to understand exactly how a feature impacts the general ledger, holds states, all of that. You aren't just building a user journey, you're actively stewarding the product through intense legal controls. Now let's pivot and look at the execution side of the house with the product owner, the tactician. While the PM is looking outward at the market and the regulators, the PO is deeply embedded in the trenches with the engineering teams. They own the how and the when. They're taking that grand strategy and turning it into actionable daily development tasks, and crucially, without breaking existing systems. Take exception handling, for instance. If a cross-border payment gets flagged by a sanctions list, the PO is the one making sure the sprint team builds the exact workflow to handle that edge case efficiently. Now, it might be super tempting for an early-stage startup to just have one person do both of these jobs. But our sources at Harrington Star warn that if you confuse or merge these roles as you scale, your delivery roadmap can easily fall 6 months behind. Expecting one person to pitch investors, argue with legal, and simultaneously manage a complex agile backlog of API integrations, that is a guaranteed recipe for burnout and product failure. Separating the strategist from the tactician is absolutely vital. And they need to be separated, because they are up against some serious monsters. Which brings us to our first huge hurdle, legacy mainframe tech. I love this analogy from 11FS. Replacing core banking is like a brain transplant or switching out plane engines while flying. It perfectly captures the sheer terror C-suite execs face. Traditional banks are running on tech designed over 40 years ago. They were built as digitized ledgers, not real-time data engines. Trying to replace them is so risky that most bank CEOs, who, by the way, only have about a 3-year average tenure, just avoid making the call entirely. And the real-world penalty of that tech debt is staggering when you look at the data. Agile neobanks running on modern cloud stacks are shipping fixes and features multiple times a day. Meanwhile, legacy banks, they might celebrate a single monthly release. For a product owner trying to manage delivery velocity, working around a legacy core system means literally every sprint is harder, slower, and way riskier. Plus, that legacy bloat directly destroys unit economics. Look at this. Traditional banks are spending around £150 per customer, while neobanks operate closer to £20. Incumbents are spending vastly more money just to keep the lights on and maintain aging IT, rather than funding actual innovation. For a product manager, this is a massive strategic constraint. Winning on price or feature velocity is nearly impossible when your baseline costs are that bloated. Alongside ancient technology, our product leaders have to navigate a second massive hurdle: relentless regulatory compliance. You absolutely have to understand acronyms like KYC and AML, know your customer, and anti-money laundering. These aren't just boring legal buzzwords. They dictate exactly how you can onboard users and move their money. If a PM doesn't grasp how a new payment rail impacts AML exposure, they could inadvertently ship something that literally gets the business shut down. One source even noted a hiring manager killed a candidate's job offer simply because the candidate dismissed compliance as something to add later. In fintech, compliance is the feature, period. Just consider the real cost of onboarding. When a fintech gets a sign-up, they have to pay between $5 and $25 just to legally verify who that person is, and that's even if the user never deposits a single dime. This is exactly why product managers in finance obsess over activation rates in funded accounts, not just top-of-funnel signups. It fundamentally alters your customer acquisition cost compared to any standard SaaS product. So, with all these hurdles, how do we actually win together in finance? Let's bring it all home. It comes down to respecting a highly structured life cycle, where the PM and PO work in lockstep. First, the PM establishes the business need and ensures the unit economics actually make sense given those hefty KYC costs we just talked about. Then, they battle test the idea with legal and compliance. Once that strategic framework is locked, they hand it over to the PO, who breaks it down, figures out how to navigate those gnarly legacy tech limitations, and guides engineering right to the finish line. It is a delicate, high-stakes dance, and both roles are absolutely essential to pull it off. I'm going to leave you with this provocative thought to challenge your own product strategy going forward. In the crucible of fintech, does your roadmap optimize for engagement, or does it optimize for survivability? Are you just building features to get clicks, or are you building a resilient financial product that will actually survive? Thank you so much for joining me for this explainer, and I really hope this deep dive helps you navigate your own product journey.